I am here with Jes Staley. He is head of JPMorgan's investment banking unit. Jes, thanks for finding some time for us.
Great, Carol.
I want to ask you about one of the numbers that stood out in the earnings report today, and that was the money that you guys set aside for loan credit losses. $3.36 billion is about half of what's been running over the last few quarters, 4 or 5 quarters. Are things that much better?
You know, I think one of the good stories in the bank's earnings this morning is, in fact, the release of loan loss reserves and the credit charges that were lower. And I think it does point to the fact that what we are seeing down the road is an improvement in credit, particularly on the corporate side, mid-corporate, consumer. The one part in there that I still think we need to be mindful of is the residential mortgage market is still troubled. Our level of losses there are still high, much higher than you would normally expect. So there's a lot of good news in there, but we still need to have some caution.
Let me ask you, though, so with that caution, is that why, in terms of the dividend, we don't see the reinstatement of the dividend yet?
I think it's more around, we would like more clarity on where capital requirements will be. Our Tier 1 capital ratio right now is at 12%, which is very high. We've got a lot of capital. But you've got Basel III coming down, and we'd like some clarity there. We did make the move with buying stock back, and I think that portends good things. But we want to make sure that when we install a dividend, it's permanent. And so we'd like a little more certainty before we do that.
Could we see that certainty, Jes, you think, maybe by the end of the year? And that we could see the dividend reinstated by then?
We'd obviously like to, yeah.
Okay, but you're going to wait and see.
I think we have to wait and see.
Reg reform. I mean, I'm assuming that that's the clarity that you're waiting to see. We've got lawmakers, they've put together what they are proposing and their legislation, but there's still a lot to be interpreted when it comes to reg reform.
Right.
I'm curious, in terms of the cost of reg reform, do you guys have any idea what that could be for JPMorgan? I realize it will take several years to implement, but you're a smart firm, you're a prudent firm. Any ideas what the cost will be?
I think it's very hard for us to put a number on it. I think this is the time where outside analysts should be making those bets and making those guesses. But there is a lot of uncertainty, as you've talked about. And I think being responsible to our shareholders, when we don't know the answer, we probably shouldn't try to make one up. It is complicated. I think by and large, the firm's going to be fine. We can do what we need to do for our clients. A lot of the regulatory reform, I think, was important and necessary. You know, the bank's got a lot of capital, a lot of revenues, a lot of clients, and I think we'll be fine in the end. And it's just too hard to put some sort of precise number on it right now.
What worries you most about the future? You talk about clarity. Is it the economy? Is it indeed how reg reform plays out and other financial regulations?
I think the most important thing for us is that we are able to do tomorrow what we do today for our clients. So the most important thing about reg reform is that it doesn't limit our ability to provide liquidity and capital to our clients around the world. So as the regulations get defined based on what has been passed or will be passed by the legislators, so long as we can do tomorrow what we do for our clients today, we'll be fine. I
need to talk about the market impact in the quarter. About a third of your revenue, I believe, comes from trading.
Right.
A lot of volatility. We had the flash crash. May was a terrible month for most classes, asset classes, I should say. Is that temporary, you think, in terms of the impact it had on you guys, or is it kind of a shift in terms of investors not wanting to take on risk?
Well, I think, Carol, you guys have been great at showing in the second quarter that investors were worried about risk and did take risk off. So we're very much a reflection of what our clients are doing. And when our investors slow down, when our investors take off risk, when they trade less, you'll see that in our top-line revenues. When corporations issue less debt, raise less capital, make less acquisitions, you'll see that in our numbers. And for sure, we hope that the investors get more confident and put risk back on the table, and issuers make more investments, and to fund those investments, they issue debt.
Right.
And all of that will translate into a rebound in our revenues. Given what our clients did,
right,
we feel pretty good about the second quarter.
You do. So does that mean you're starting to see some signs of confidence coming back and not so much risk aversion out there?
No, I think there's still a lot of concern about the markets. I think when you look at cash levels on corporate balance sheets, as we talked before, I still think that investment is being held back. So there's not the level of confidence that we'd like to see, but I'm sure we'll get there. And I think getting regulatory reform behind the markets will be one more step in providing confidence in the market to begin to reinvest.
Jes, let me ask you about your business. You run the investment banking business. We saw declines also in the quarter there. Do you expect that to continue?
To continue declining, no. I think we've seen the market sort of settle down. There are some green sprouts of confidence coming back in. I think the improvement in credit quality overall, what we're seeing in terms of releasing loan loss reserves, investors will see. I think that will put some renewed confidence in the market, and investment's going to begin to happen again. And the bank will benefit from that. I also think that we did fairly well managing our risk in a market that was de-risking. So, the overall picture, the numbers I hope get better, and I think they will get better. But I think that how we did, given the nature of the market in the second quarter, makes us feel pretty good.
Well, it's interesting. If you look at the economy, there's so much debate out there about kind of what's for the next 6 months, as we've seen a lot of the stimulus measures come off and step off. I'm just curious how you guys are looking at the outlook over the next 6 months. I think you, as a firm, have brought in some of the growth estimates. So, again, you're a little nervous, a little cautious.
I think you've got the balance of the global economy trying to wrestle with the implications of a level of sovereign debt that we haven't seen before.
Right.
On the other hand, I think you've got regulators that are trying very hard to provide support for economic growth, whether it's fiscal policy or monetary policy. And I think you've got asset classes that are fairly conservatively marked. So it's understanding the sovereign debt issue. It is recognizing that you've got interest rates that are at very low levels around the world, and asset prices that are fairly valued or, if not, undervalued. So if I, were to think there'd be a move, my bet would probably be to the upside rather than the downside. But no one wants to predict the markets these days.
All right, we're going to leave it on that note. Jes, thank you so much.
Thanks, Carol.
All right, talking about Jes Staley of JPMorgan.